Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just got done interviewing Jamie Bateman, professional note investor with Labrador Lending. Anthony, what was a takeaway or two that you had from today's conversation?
To be honest, for me, I didn't know much about note investing. So for me, this was a good way to kind of understand the pros and the cons and kind of like an example. What did you have a takeaway?
I did. You kind of took it there. I thought he did a really good job of kind of giving us an overview of notes. He talked about, how you can find these, what it takes to manage them, and then also kind of your exit strategy on the back end. And then he spent some time going through kind of the advantages and the disadvantages. So I agree with you. I think this would be a great introduction for listeners that are not too familiar with notes. And he also has some resources that he shares at the end that if somebody wants more information, they can reach out.
Another takeaway is it's always good to hear how somebody else is using infinite banking in their business. So he does share that at the end. And if you're wondering if infinite banking is for you, can that help you achieve your goals faster and with more certainty, hop on a discovery call with Cameron and I, and we're kind of talk about it and see what the answer is.
Yeah. Hope you guys enjoy this episode.
Take care.
Jamie, thanks so much for joining us today. If you could start with kind of your background and how'd you ended up kind of in this niche of notes, please.
Absolutely. So
wait. Jamie. Okay.
I don't know why I said please.
We're not cutting this out, but he just said please. And that's kind of thrown me off a little bit. But I'm sorry, Jamie. I just had to go ahead and point that out. So
I'm a nice guy.
Please proceed.
I'm a nice guy.
I mean, nothing wrong with saying please.
No.
My mom would be proud.
Exactly. So I got out of college and quite frankly, wasn't 100% sure what to do. Probably a lot of your listener base can relate to that. And my first real job was with a title company. And I came to understand there that I hadn't learned anything in school about title insurance or mortgages or anything like that. So that was pretty apparent right out of the gate as far as, as an early adult. Ended up, I joined the military and I still actually work for the Department of Defense part-time, but over the years, I guess it was 2010 is when we bought our first rental property. So it's just one of those things we wanted to kind of diversify out of the stock market a little bit. And my father has been a real estate agent for many years. My brother is a loan officer. So I wasn't unfamiliar with real estate. And so 2014, 2015, I was getting real tired of my full-time gig and the commute, and started listening to a lot of podcasts, a lot of Bigger Pockets podcasts and other podcasts, reading a lot of books on real estate, primarily buy and hold, rental properties. And so in 2015, I went part-time at my quote unquote real job and started taking the real estate thing much more seriously. So my wife and I were very intentional about treating it like a business at that point and scaled our portfolio in Maryland. We did several pretty decent sized rehabs at that point and essentially using the BRRRR method to scale our business that way. And it was really kind of a mindset shift at that point was, or I guess prior to, probably 2014, 2015 is more of a mindset shift where you look around, you say, what am I doing? Where am I headed? And what are my strengths? And so I started to realize with my father, my brother, and the title experience, actually my wife had worked for a title company as well. So instead of thinking about just the obstacles or, woe is me, treating yourself as a victim, I started to really focus on taking control and looking at my strengths and my own network. Kind of stopped watching the news at that point and just started to focus on what I could control. And so that was the foray into the real estate. Just quickly, once about end of 2017, I started to learn more about mortgage note investing. So early 2018 is when I really kind of made the transition from rental properties to mortgage notes. We still have our rental portfolio, and it's slowly growing, which is a whole separate topic. But then since 2018, I've really been focused on mortgage notes, and we can go into the pros and cons of each of those asset classes. Everything has, there's no perfect asset class or perfect investment strategy, but 90% of my, I guess, business focus right now is on mortgage notes.
Well,
can you explain to Cameron what a note is?
Anthony knows nothing about notes, so let's start there.
Well, the problem was when we booked this, Jamie, I told Cameron we have a guy talking about notes. He thought it was like classroom notes, like passing. But so if you could,
it's
guide him.
Yeah, we'll dumb this down for Cameron, right, Anthony?
Okay, thanks.
Thanks, Jamie.
So. So in its most basic form, a note is a promise to pay, right? So it's literally just a piece of paper. It may not even be a piece of paper, but we'll call it a piece of paper that's a promise to pay back an amount of money. So it's a loan. Now, when people say notes, they're typically referring to mortgage notes when they invest in notes. So I invest in first lien mortgage notes. Really what that means is most of your audience can identify with having a mortgage, or at least understanding what a first mortgage is, right, on a property. So as a mortgage note investor, I purchase those mortgage notes. So I don't own the property, I own the mortgage note. So I become the bank, and there are many different ways to go about, finding these notes, and many different strategies within this niche that a note investor can take. But a mortgage note is the promise to pay, and that's typically so in the first lien mortgage space, that note is actually collateralized by the property, and that is done through either a mortgage or deed of trust, typically, depending on the state. So getting a little into the weeds there, but the note itself is a promise to pay, and in a mortgage situation, that property is actually the collateral of that note.
Okay. Do you understand, Cameron?
I'm following you.
Okay.
Where do you said you've got a lot of different areas of finding these notes. Maybe cover the top 2 or 3 for us.
Yeah, I mean, so this is frankly has become a little bit more of a challenge, deal flow lately, and that's true for most real estate as well. Real estate investing and note investors we've had a little bit of struggle recently with finding assets, but. So banks will sell off. Essentially, you have two sectors, or two big sections of the note space, and one is institutional bank financing. The other is private lending or seller finance notes. So we buy both, but on the institutional side, banks will sell off their non-performing assets for a variety of reasons, and those eventually will trickle down through hedge funds and then smaller note funds and other note investors. So there's on the institutional side, you can really focus on. I don't contact banks, frankly. Some gurus out there will teach you to call banks, and I haven't found it to be very productive, frankly. I'm a little guy in this space, compared to some of these big funds. So, hedge funds and note brokers are really good sources, and then also you can find some good deals through mom and pop landlords or seller financed owners of seller financed notes. That's another avenue. So there are some online exchanges, like paperstack.com is a good one. Notesdirect.com is another one. They all have, they're all different in different ways. I actually have a short video on our YouTube channel going through 12 different sources of notes if people want to check that out. So.
Nice. Okay. Yeah, we'll be sure to add that in the notes.
So Jamie, nice. What I'm hearing is that what you're doing is you're buying, somebody already initiated the note.
That's right.
And then, first, why would they want to sell it? And what does non-performing mean?
So why they would want to sell it, it depends on their business model. But if it's a non-performing asset, so banks they can only, I'm sure you're familiar with the fractional lending and that stuff. And, that's a whole separate topic, but they can only lend up to so much if they have non-performing assets or toxic assets on their books. So banks have to get rid of non-performing loans in order to lend out more money, which is how they make their money. An average note investor may sell off loans for a variety of reasons. It could be that they were managing a fund, and the fund is liquidating, so they need to sell these assets off. So it may be something where there's nothing actually wrong with the note itself. It may be a life circumstance or just part of the business model of that note investor or that hedge fund or that note fund could be selling off those loans. So it's a variety of reasons, frankly. And your second question, a non-performing note is a note where the borrower is not paying or at least 60 to 90 days behind. So they may be paying on the loan, but they're behind, they're delinquent. So, in the kind of average world, most people think, everybody pays their mortgage, right? Obviously you pay your mortgage. Well, not so much in the world that I run in.
Okay. Well, what are some of the advantage, and just like you even said it earlier, and we even say that as well, there's advantages and disadvantages to doing everything. So yeah, what are they in regards to note investing?
Note investing, some of the advantages, you can scale fairly easily. You can do it from anywhere. It really is location independent. If you have an internet connection, a cell phone, and a computer, you legitimately can be a note investor. It's tough to scale too far with just by yourself and a laptop, but the ability to scale is absolutely there, and the barrier to entry, frankly, is fairly low. That doesn't mean that everyone should be a note investor, but you can become a note investor if you do your own due diligence and your education and training and know what you're doing. Barrier to entry is pretty low, and the ability to scale and to do it from anywhere. Some of the things I love about it. Also, the exit strategies. There are many different exit strategies. So you've got on a particular asset, meaning a non-performing loan, you're not typically stuck. So you normally have, even if it doesn't go exactly how you wanted it to, with note investing, you often have options, and there's a lot of there's versatility and options there. Flexibility with how you actually exit the deal is another great benefit.
I don't know if you got to the disadvantages yet, but something that came to mind was, or if you let's touch on those, and then I got another follow up for you.
Sure. I mean, absolutely, there are, and nothing's a perfect asset class. Some of the disadvantages, there really are no inherent tax benefits. Real estate has, at least for now, has tax benefits. There's no depreciation in note investing. You're more often than not being taxed at your ordinary income rate. And I know you're a CPA, so you know more about that than I do. But there are no inherent tax benefits. You can't. Another downside, I would say, to note investing is it's difficult to leverage. So you can't really walk into a bank and say, I need a loan to go buy this loan. Right. So there are ways to do that. And we can get into all that hypothecation, selling partials. There are ways to, and this is where it gets into infinite banking, frankly, is that there are ways to expand your business and find access to capital to fund that business. But those are a couple of the disadvantages of note investing.
Awesome. Thanks for covering that.
In the advantages, did we mention passive income, right? Is that
so? Yeah, no, great point. I mean, it absolutely can be passive, no question about it. Now this, and Chris Seveny and I have a podcast, and we kind of go back and forth on, is note investing passive, right? And it can be, for sure. It depends how you define passive. I'm not out there swinging a hammer at all. It's physically not demanding in any way, shape, or form. So it's passive in that sense. And you certainly can, performing notes are generally pretty passive. So people talk about mailbox money, and it's certainly a thing. I mean, I would say it's more passive than rental properties, certainly more passive than like fix and flip, and residential real estate. But I do want to, at least insert the caveat that if you're running a note business where you're buying non-performing assets, you're adding value to those and you're exiting those through either the borrower or the property. Those are really the two primary ways to exit those deals. You're having to do some work. It's a lot of tracking down of attorneys and vendors and servicers. And so again, it's primarily at your desk or on the phone, but there's some work involved. So it's not entirely passive if you're going to scale in the non-performing note space.
Okay. Well, I do appreciate you being upfront, because a lot of times people will say, "Oh, this is completely passive," and then
right, exactly,
it's not quite so.
Exactly, and there, and I have not intending to, pump up my blog, but we do have a blog post about is note investing passive, or how passive is note investing, right? And there absolutely are passive ways to be a note investor. Investing in a mortgage fund, a note fund, is very passive. If you do a hypothecation and lend to a note investor, or if you buy partials, that can be very passive. So there are passive ways to go about it. But if you're going to scale, run a note business, I would tend to put that in the less passive category.
Can you describe maybe a typical note or typical deal? Maybe on how much it takes to get started, and then expected returns?
Really good question, because I think people can relate to things when we put some numbers to it. Yeah. With that said, it depends. It depends, I'd say in the first mortgage space, first note space, it's a little bit higher generally to get in. That's why some people do prefer second mortgages. That's one reason, is they're generally less expensive.
What would be higher if we can? I'm going to push you to kind of put some
no, that's fine. I would say if you're going to get into this space, you should at least be looking to buy a note for $25,000 to $50,000. Now, some people might think that's high. Other people might say, "How can you get a mortgage for that low of an amount?" So, a lot of and note investing ends up being very state specific. And that's primarily due to different state laws. But a lot of the Midwest is really good for a newer note investor who may have $25,000 to $50,000 to get started. And I typically recommend a note investor buy one or two performing notes first, just to kind of get the taste and understand how to board a loan with a servicer, how to do a transaction. The problem is they're more expensive, and so you run out of your own money pretty quickly if you're going to get into the first mortgage space. But more directly, I'd say $25,000, $30,000, you can get a performing first lien mortgage note, and you may be buying that at you can target a 10 to 13% yield at this point. Yields have come down, pricing has gone up. Like I said, deal flow is more of a challenge lately, but absolutely $25,000 to $30,000 can get you in at maybe a 10 to 13%, maybe even a 14% yield. That's for a performing note.
Okay. So, one question would be so here's a mortgage that has an interest rate of 14%. Like, why don't they get a traditional mortgage?
So, okay. First of all, and one benefit I didn't mention about note investing is you're almost always buying the note at a discount.
Okay.
And so if you're buying the note for $25,000, that principal balance is likely $30,000 to $35,000. And we're talking about a performing note that's they're paying every month. So the interest rate is likely more in the 9 to 10% range in this world that we're talking about.
Okay.
Why they can't get a traditional mortgage, and I think this sector is only going to grow. It's banks don't want to lend on houses that are worth $100,000 or less. I mean, it's just, and it's gotten harder and harder in the last 14 months, I think, to qualify for a loan. So even though rates are down, mortgage rates are way down. There's a whole sector there between, housing properties of 50,000 to 150,000 that seller financing is really the way to go for a lot of these people. They may be self-employed, or they may have had a bankruptcy or something, so their credit may not be phenomenal, but they're good, hardworking people who generally pay their mortgage. And but because of that risk, from the lender's standpoint, they're not able to qualify for a traditional bank loan, and therefore their mortgage interest rate is going to be higher.
Okay, so in this example, we bought a note that has a principal balance of about 30,000, but we only paid 25. Is that?
Yeah, it's very doable.
Okay. All right. Mm-hmm. So my first question, why would the bank sell it to you for 25?
So time value of money, I mean, it's really opportunity cost. If they can get their cash back and put it to work somewhere else. It's likely in this case, it's not a bank. You're probably buying it from another note investor or a note fund. Mm-hmm. They may be, like we touched on, they may be liquidating their fund or something, and they just need to sell off assets. Nothing wrong with the asset. They just need to sell it at that point. Maybe their business model changed. Or it could be a reperforming. A lot of these are reperformers, and that's where it ties into the non-performing space. So I'm selling a loan right now to give you more of a direct case study. I bought this as a non-performer about 12 months ago, not even. And we got it reperforming. We modified the loan. We got it reperforming. I'm selling it as a reperformer, which is more like a true performing loan. So I'm selling it because I bought it at more of a discount, and then I added value to it, and I'm selling it as a performing note. But the note buyer is getting a decent note where the borrower is on automatic ACH, scheduled ACH payments. She's been paying early for about 11 months now, and his yield is 13%, the buyer. So, I mean, it's a great question, but I think there's so many factors involved. And, as the life of the loan goes on, for an amortized loan, there more and more of that payment becomes principal. So it becomes less valuable to hold that note. So why not take that money now, or most of that principal balance now, and put that back to work, either originating notes or whatever the business model is for that note seller.
Is that a typical timeline for you, about 12 months to hang on to one?
So for a non-performing loan, so yes, I'd say maybe 8 months to 2 years for non-performing loans. Now with the pandemic and everything, if you're going through foreclosure, I mean, it's been really drawn out. So we've had to add 6 to 8 months per non-performing loan, if just to have that kind of cushion baked into the numbers up front. Performing loans, so we buy both performing and non-performing loans, and the performing loans I think of more like a buy and hold rental property. Mm-hmm. It's nice for cash flow. It keeps our lights on, so to speak. It helps fund the business on a day-to-day, from that perspective. And you can also do things with performing loans that you can't do with non-performing, such as sell partials, for example. But performing loans are kind of steady and boring. And we do buy those to kind of just, like I said, run the business. They're more work from a bookkeeping standpoint because there are more transactions involved. And we also focus on non-performing loans, and that's where we can add value, and that's where you can profit more per deal. You can also lose money, but on a non-performing loan, I'd say 6 months is real short to try to exit that. And then I'd say 18 to 24 months is really what you should plan on as far as a timeline of holding that asset.
I'd like to maybe walk through this kind of example we started, where the loan balance is 30,000. We paid 25. So one of the reasons why we're getting such good returns is because that interest is a little bit higher on the 30, right? But we only
Right.
invested 25. So that's
Correct.
where, okay. So what, in this example, what would about the house be worth?
Good question. And probably, well, nowadays through the roof, I guess, but
Yeah.
$1 million.
seems like, right. Exactly. um, yeah. A couple of 2x4s, but, no, I mean, I would say $50,000, $50 to $100,000. It really can vary. It's hard, but let's just say, let's say $75,000 is the
Okay. All right.
property
So
value.
we got some equity in there. And this, let's say that they make a couple payments and then they
Stop.
don't. So now it's non-performing. So
Correct.
you're telling me that they can sell the note to somebody else, or what else could they do?
So great question. There are many different exit strategies for a non-performing loan, and we will try to exit through the borrower primarily, initially, I should say. I mean, our goal is to work with the borrower and get them reperforming. Normally speaking, I would say it's more profitable to do that as well. And obviously, we're not in the business of trying to kick people out of their home. So you can do several different things. You can do a deferment where you're just pushing payments, back to the end of the loan or 6 months from now. And with these types of loans these are not, GSEs, these are not government sponsored entity loans. So we have a little more flexibility with what we can do. That it's typically more private financing. So you can do a deferment. You could do a modification if it really comes to that, where oftentimes a note holder will put. So a lot of times an investor will do a trial payment plan for 3 to 6 months, get them paying again, and then do a modification, give them some kind of, I mean, ultimately it's kind of like parenting. You have carrots and sticks, and it's like you're trying to encourage a certain good behavior, and it's not always the borrower's fault. They may have been unemployed or something like that, but you're trying to get them back on track and get them reperforming. So a modification where that's a permanent change in the terms of the loan, you might be lowering their payment, increasing the term of the loan, excuse me, and then get them paying that way. Other exit strategies through a non-performing loan might be a deed in lieu, where they actually deed the property over to you. And we've done that before. For example, in Jacksonville, Florida, we had one where we did a deed in lieu, and now it's actually in our rental portfolio. The property is. So we were trying to work.
Explain what a deed in lieu means.
Yeah. So a deed in lieu is a deed in lieu of foreclosure. So instead of me as the lender or investor foreclosing on you as the non-paying borrower, you sign the property over to me. And so the reason you might do that is that might actually be a better deal for you from a financial standpoint. And it also does not go on your credit history as far as, foreclosure. So it's quicker, cleaner, less expensive for the note investor as well. Normally, instead of, for example, in Florida, it could be 6 to 18 months and pretty expensive to go through a foreclosure. We were able to do that in a couple months, get the property back. And it actually, in her case, wiped out about $25,000 of debt. So a deed in lieu is where the borrower, homeowner, signs the property over to, they deed the property over to the note holder or the note investor in lieu of going through a foreclosure.
Okay. So then they could obviously go through the foreclosure, right? But so in essence, in this example, the house is worth between 50 and 70, but we have 25 grand in on the deal. So do we own the whole house, or what happens once we foreclose or deed in lieu? So
it would go likely to auction, foreclosure auction. And then you set the bidding at where you think it might sell, or what you want, your minimum that you'll take for that property. And then if it doesn't sell at auction, then you own, it's called an REO, real estate owned. It's a bank owned property. So I'm not looking to expand my rental portfolio too aggressively. I will if it comes along, but So my goal isn't to take back properties. And at this point, if we do take back properties, we will normally, do a little bit of cleanup, not a full rehab, and sell that property on the open market. And then maybe a real estate investor will come in, fix and flip it, or create a turnkey rental or something like that out of it. But one key misconception or common misconception is that as the investor, if you foreclose, that you get that equity that's between the equity in the property, between the mortgage and the property value.
Mm-hmm.
That is not the case. Now, land contracts and contracts for deed are a whole separate topic. We can do a follow-up podcast on that. But in that case, you do own the property as the lender, and we've bought a bunch of those as well. But that's a little bit of a nuanced part of note investing. But typically speaking, if you're the first mortgage note holder,
mm-hmm.
you're not getting that equity. So you're only owed what you're owed, meaning the full payoff. It may be more than that principal balance. There may be some arrears. There may be some, previous charges from back taxes or something that you've paid for. So you may be owed, in our example, you bought it for $25,000, principal balance was $30,000. They may actually, the full payoff may be $35,000.
Mm-hmm.
You may get that $10,000, more than what you have into the deal, but you're not getting $75,000.
Okay. So you sell it at auction, say for 35. So you get the 35, but then, so somebody else bought this house that's worth between 50 and 70 and they only paid 35.
Well, I would say in that case, if they paid 35, it was worth 35 because that's what the market said it was worth. But really it's the borrower's equity there. If somebody bought the house for 75, and that's what I think we're going to maybe start seeing more and more of. I mean, I think we're going to see some bankruptcies, but or the property's going to the open market and the borrower, they're unable to pay because their income stream has dried up, but they still have equity locked up in this house.
Mm-hmm.
Their best option may be to, kind of recapitalize that equity, if you will, and let go of the property, and kind of start over or pivot or something. And that is one thing I will say. Sometimes these borrowers, they actually need us to kind of push them to a different situation. Some of these are really not healthy situations, and they're not making their payments. They're not on a good track. And so sometimes it is a matter of, almost like a loving action where you're kind of putting this person out of their home onto a new, kind of a fresh start, if you will.
Jamie, I've got a question. How much, maybe it's two questions, but you mentioned scaling before.
Yeah.
How quickly can somebody scale, and are they scaling kind of that passive income piece to it? What are they going after there?
Yeah. So I like to break down and I didn't come up with this, but break down the note business and many other businesses as essentially three things. One is access to deals. So buying the notes themselves, the assets.
Mm-hmm.
And then two is managing those assets. And that's a part that a lot of people miss. But three is access to capital. And you can't scale without access to capital. You're going to run out of your own money, or going to run out of the money that you have set aside for your note investing venture. If you're trying to scale, you need to figure out a way to find additional funds to purchase more notes, right? It's a cycle. So, I mean, scaling, just like any other business, you definitely need your systems in place. And, whether you want to outsource everything, or if you want to kind of bring everything in home. So my spouse and I each worked for title companies, and she helped me a lot in the beginning of this venture with running due diligence, doing recordings, just checking kind of all the paperwork. So, in that sense, we had kind of a husband-wife team in the note space. And now I also have a contractor who works with me. He's a newer note investor who's learned a lot through working for us, but I've benefited greatly through him as well. So building that team, and now I also have a virtual assistant, but I think building that team out, whether it's note investing or not, is critical if you're going to scale. But those are the three kind of primary pieces, and so everything that we do fits in one of those three buckets. And that's where for me, the infinite banking side of things has come in, is the access to capital, and that's really helped us scale.
How have you used IBC to scale?
So I stole it from Anthony. So
that's another thing you and Cameron have in common, but go ahead.
So I got hooked up with with Russ and Joey at Wealth Without Wall Street, and started kind of relearning infinite banking. I learned about it before and kind of didn't take any action. And then I relearned about it maybe 3-4 years ago. I guess it was kind of around the time I was starting my note venture as well. And just decided to go for it. So Anthony, you did a presentation in the Wealth Without Wall Street community on how to fund your business using an IBC policy. And I think you have a shorter video as well. I've watched a 6-minute video or something like that kind of really breaks it down. And the visual was really helpful for me. So that literally is exactly how I do it. And so we borrow from, I'm sure you guys have covered this on your podcast, but we borrow from high cash value whole life insurance policies, which happen to be probably the best tool for infinite banking. And then we lend money through our personal account to our businesses. And I, read the Becoming Your Own Banker book and everything. And it doesn't mean I'm the expert on IBC, but it kind of clicked a few years ago when I realized, like, wait a minute, this policy continues to grow regardless of what I do with the loan. So that part blew my mind. And then secondly, that you have you have so much flexibility when you're paying the loan back. It's really hard to find that with a bank loan or something else where there's really, you set your own terms. So that's something I really, really like about it. I would say some people could get into trouble if they're not disciplined enough with that approach, but we take those IBC policies, we borrow against them, and we fund our note business as well as some of our rentals to help scale. So that helps with the access to capital piece, which is a 1/3 of the puzzle.
Mm-hmm. Jamie, what would you say if somebody's on the fence about infinite banking? What advice would you give them?
Yeah, here's what I would say. It doesn't need to be as controversial as it is. One thing I like about being an entrepreneur, doing infinite banking, is that I can make it what I want. And so, do my wife and I buy groceries through IBC? No, we don't. And I mean, so is there a next level we could, yeah, do we use bank loans? Yes, we do. So I'm not, to the extreme of, I think seems like Nelson Nash was a really, kind of a super smart pioneer, and I have a lot of respect for him, but there are many ways to do things. So what I would say is, find what works for you, investigate it more. Don't just, write it off because you read something online that it's so expensive and it's the worst thing you can ever do. Research it, take the time to talk to someone who's actually doing it. And another key piece, and I think this is lost on a lot of people, you don't take a policy that wasn't intended for infinite banking and try to force infinite banking onto it. The policy should have been designed for that reason. And if you're using a policy, where the death benefit is super high, the cash value is low, the fees are outrageous up front, or too much of a term policy, it's not going to work, right? And this is where you guys can, teach me. But my policies, we have 4 policies. My wife and I have a policy, and on on ourselves, and then on our 2 kids. So we have 4 policies. The 2 big ones are blended. There is a term portion of it for 10 years. So, it's not like I'm anti-term, but I'm also not of the Dave Ramsey ilk where it's, term only and invest the difference. So do your own research, talk to people who are actually doing it, and then make sure the policy is designed where it will work for this strategy. And critical to all of this is working with someone that you trust and that knows what they're doing. And so
that's key.
You just can't get around that part, whether it's note investing or setting up a life insurance policy. I don't know everything. I mean, there's an element of where I ended up just trusting the Wealth Without Wall Street guys. I mean, yes, I read what's in the policy, but I'm not the expert. So there's an element of trust there.
Jamie, speaking of kind of the mentorship or finding somebody to kind of teach you how to do this, if someone wanted more information on note investing, where can they find you?
So LabradorLending.com, LABRADOR, lending.com. That's our website. And then Chris Seveny and I also have a note fund, and I have some information on my website, LabradorLending.com, and then IntegrityNoteFund.com. So it's the Integrity Mortgage Note Fund is our note fund. And then we also, shameless plug for our podcast. It's the Good Deeds Note Investing podcast. I think it's one of the more popular, if not the most popular, note investing podcast. And we really like to think people get a lot of value from that. We like to tell it like it is. Like I said, we went through today pros and cons of note investing. There are definitely no cons to notes. So I think if you keep it real and you're honest with people end up trusting you, and that only helps everybody in the long term.
I couldn't agree more. Jamie, thank you so much for your time today. Appreciate it.
Yeah. And Jamie, we didn't say it earlier, but thanks for your service in the military and for explaining to Cameron how notes work.
Yeah, absolutely. Cameron, I'm glad we could bring you up to speed.
I appreciate it. I learned a lot today.
I always do every day.
Awesome, Jamie. Thanks for coming on, and go make it a fantastic day.
Take care.
Thanks, guys.